Good evening, everybody, and welcome to this evening's edition of Women and Money Montreal. My name is Lynn Sock. For those of you who are attending these Tuesday webinars for the first time, I just want to give you a little bit of background and history of what Women in Money Montreal is and who I am and what we're all about. My background, I'm an independent financial security advisor, Quebec-based, and I founded the Women and Money Montreal community back in 2020 at the beginning of COVID. And tonight is actually the 120th weekly financial literacy session that we're hosting. So I appreciate everybody coming out and still attending these sessions. Every week, every Tuesday, 7 p.m., we go over a different topic related to personal finance, investing, or real estate. I try to explain everything in simple, everyday language, and I try to avoid jargon as much as possible. We also host the Breakfast Club for Women Entrepreneurs every Friday online, 10 a.m. Again, we discuss different topics that affect women that affect entrepreneurs. If you're joining from Meetup for the first time, or if you're attending for the first time through the Facebook group, or if someone told you to attend, hi Monica, if someone told you that you should attend, I invite everyone to join our Facebook group where there's a little bit more interaction, and I usually post summaries and other things that are going on in money. If you're not already signed up to our newsletter, you could go to my website, which is linsock.ca. At the top of the page, you'll see the link to subscribe to the newsletter. It comes out once a week and basically goes over any webinars or other events, or I know we send out mortgage rates and key information that might be important upcoming in the week. Once again, I appreciate everyone coming out this evening, either live or maybe some of you might be watching the replay later on. These Tuesday sessions are recorded, so everybody who registers will receive a copy of the recording immediately after the session. So whether it's tonight or a future Tuesday webinar, if there's a topic that you're interested in, but maybe you can't attend or you can't sit in through the whole thing, register anyway. You'll receive a copy of it immediately following the session. So if anybody has any comments while I'm presenting, please feel free to drop them in the chat and then I'll answer them as we go along. So if you've been attending for the last few weeks, we've had tonight's basically the last part of our Investing Basics series. The last 3 weeks, I went over a lot of investing terminology and basics. Hi, Jenny. A lot of terminology and financial jargon. Tonight, I'm going to try my best to not bring up any financial jargon. Tonight is really about, okay, I have all this information. What next? So tonight, I'm closing out the Investing Basics series with 4 questions to ask yourself before investing. And once again, tonight is not about explaining jargon. I've spent the last 3 weeks talking about that. Now we're talking about, okay, cool, I have all this info. Now what next? So I broke it down into 4 questions to ask yourself. The first question to ask yourself before you start investing is, you need to ask yourself, how am I financially? How are my overall finances? So what does that mean? Because some of you may have heard this before, like what's your financial situation? That could mean so many different things. But what we're getting at is when you're looking at your finances, do you have income stability? Like, do you have a stable job? Or are you somebody who bounces around from job to job? Or are you someone who works on contract, maybe because of your field, or maybe because you're somebody who doesn't like to have a permanent full-time job? Maybe you're a business owner and income is sporadic. When you're looking at your overall finances, it's important to take a look at how stable your income is, because if you're someone who receives a paycheck every 2 weeks and you've been at the same job for a few years, the way that you approach your finances and investing is going to be very different from somebody who is constantly looking for another job, never satisfied. You look at you're always looking for work. Maybe you're self-employed and the income isn't coming in on a regular basis. So ask yourself, do I have income stability? How stable is my income? Are you paycheck to paycheck? Do you always have access to cash flow? this is a very important question to ask. Like, just ask yourself, if you needed money for anything right now, you're driving to Ottawa and your car breaks down. One of your kids has an emergency and needs $200. That's actually my daughter. She needed $200. She forgot to tell me that school fees were due for CEGEP. Do you always have access to cash flow? Another question to ask yourself, if life throws you a lemon, where will money come from? So what do I mean by that? I mean, if you're sick, whether it's for a short period of time or a much longer period of time, maybe because of a disability or something else that's more serious. If you get laid off, maybe you need to care for a loved one. If life throws you lemons, where will money come from that you need to be replaced? Do you need an emergency fund? So again, looking at your financial situation, do you have a little bit of money here, a little bit of money there? Do you need an emergency fund, or do you need to start an emergency fund? Are you in debt? Debt management is really important. If you are in debt, you're not going to invest the same way as somebody who is heavily in debt. Simple questions like, how much can I put aside for a rainy day? Again, I can't answer that question for you. Your best friend can't answer that question for you. Your family member can't answer that question for you. It's taking a look at your overall finances. And lastly, do I have a retirement plan? At the end of all of this, of all the years that we're all going to be working, at some point we're going to want to retire. And no matter what, even if you're just starting out, maybe you finish school, whether it's trade school or university or CEGEP or whatever it is, do you have a retirement plan so you could comfortably retire when you want, whether that be at age 65 or at age 55 or age 71? If you're nowhere near retirement, guess what? You don't know when you want to retire. So these are the questions to ask when you're taking a look at your overall finances. It's the first question to ask before you start investing. This conversation with yourself could be, a couple minutes long. It could be a whole day thing. It could be, oh man, this is a lot. This is overwhelming. I need to take a full Saturday to look over my finances because everything is all over the place and I don't know where anything is. When you're looking at your overall finances, I know it's extremely basic, but you need to have some type of tracker, some type of budget. I've gone over budgeting and managing your day-to-day personal finances in previous sessions. If you don't have a platform or some way to keep track of where your finances are coming and going, reach out to me. You can send me an email. I have an Excel sheet. It's a budget template where you keep track of your money in, money out. If you don't like Excel, there are apps that are available. I know one of the more popular ones is You Need a Budget. Very, very simple. There's no secret magic. You have to know what type of financial situation you're in. I'll share it with you. Like for myself, I know that if I needed money at some point, there's access to money somewhere, right? So the way that I'm going to invest is going to be completely different from someone who's paycheck to paycheck. So you have to ask yourself those basic questions about your finances and get real with your finances if you don't already know. And guess what? It doesn't matter what your income level is. I've seen people who earn $40,000 a year who are extremely financially stable, and they're like married to their numbers, like they know their numbers. And then I know people who make $250,000 a year and they're living well beyond their means. So first question to ask before you start investing, how are my overall finances? Again, if you're hopping in, you can put your comments in the chat. Pascal, yes, I'm going to send you a copy of the Excel sheet. If anybody else, just because I'll have all the comments at the end of the session, but just shoot me an email and ask me for the Excel sheet because I might not remember. So how are my overall finances? Second question to ask is, what is my goal with this money? So whether you currently right now have lump sums of money here and there, like you might have some $10,000 in a TFSA, maybe I have $100,000 in my checking account because I just moved here from France and I transferred all my money over. or you're just starting out with $50 a month that you want to contribute somewhere. No matter where you're at in your investment jersey, what's your goal with this money? And for some of you, you might have several goals. So you need to ask yourself, whatever these goals are, how long do I have? And how married am I to these goals? So prime example is a goal that a lot of people have is I'm saving up to for the down payment to purchase my first home. Okay, great. How long do you plan? When do you plan on buying this home? If your answer is, I need to move out next year because I already told my landlord, I need to buy something next year because I already told my landlord that I'm not renewing my lease July 1st. Well, that's a very stiff time frame. You need to be able to come up with some money for next year for the down payment versus, you know what, I might want to purchase a house in the next few years. I'm not sure when. I want to put money aside, see how things go. You're not really married to that date. You're not married to a date. It's more flexible. So how long do you have until you need to reach this goal, and how married are you to your goals? I'll give you an example. I just received an email from a client today. When we first met, she had a TFSA and she was saving up. She had money aside towards a down payment of a condo. She wanted to buy a condo. When we worked out some numbers a couple of months ago, it just didn't make sense for her financially to purchase. Not that she wasn't in a good, stable position, but her situation was, it wasn't really the best option, but she went ahead. She's like, you know what, let's see what happens. I'm still going to put money aside. I'm saving up towards a down payment. She sent me an email this morning saying that, you know what, can we change the investments in my TFSA? Because I don't think I'm going to buy this condo next year. And in fact, I don't know if I'm going to ever buy this condo. Can we invest the money in my TFSA more aggressively as opposed to conservative, which it is right now? So your goals could change, your time horizon could change, that's fine. But always ask yourself, what's your goal with this money? Is it for retirement? Is it for a short-term goal? How long do you have until you need this money in your hands? And how married are you to the timing of it? Like, do you have to move out July 1st? Is that it's a deal breaker? You have to move out next year, or it's like, I'll see what happens. Other goals that you might have with this money could be, like I mentioned, saving for the down payment of a home. Maybe it's for retirement. Doesn't matter what type of account it is. It could be an RRSP, TFSA. That's not really what the issue is. It's this money that you're putting aside in very plain, simple language. What is this money for? Is it for retirement? Are you trying to create maybe a cushion or an emergency fund? You just paid off all your debt and now you're starting from scratch. You don't have any savings. So right now, for the moment, so you don't get back into debt, you just want to create a cushion. Maybe you don't have any goals. Maybe you're like, you know what? People keep telling me I have to put money aside. So I'm putting money aside. I don't really want to buy a house, or maybe you have a house that's already paid. Maybe you don't have any goals. And that is a goal in itself. So what is this money for? Why are you putting this money aside? And perhaps you might not even have a goal, which is kind of a goal. Again, if there's anyone who has any questions, feel free to pop them in the chat. Third thing is, okay, great. You looked at your overall situation, you have some debts, you have a debt repayment plan, you have stable income, you take a look at your money in, money out, and now you're going to start putting money aside. Maybe you meet with an advisor, or maybe you're doing your investments yourself on a self-directed platform, or you plan to, whatever it is. You need to ask yourself, do I understand my investments? So whether you are currently investing right now, or you're looking into investing, do I understand these investments? Do I understand what these investment options are going into it? And or do I understand the current investments that I have? What does that mean in plain, simple English? Can I tell my best friend what my investments are? Think of it as food. I use a lot of food analogies. So an all-dressed pizza is an all-dressed pizza. No matter which restaurant you go to, you can kind of identify what an all-dressed pizza is. You could probably, even if you don't know how to cook, You could probably tell your best friend what's in an all-dressed pizza, more or less. Now, if you are allergic to cheese and you're thinking of getting an all-dressed pizza, you might want to mention that I can't eat any cheese. I'm lactose intolerant, so I need this special kind of cheese, as an example. Think of this as like the risk levels that you do need to know. And at the end of the day, an all-dressed pizza is an all-dressed pizza. Your investment is still your investment. You don't have to know every single ingredient in your investments or every single ingredient in an all-dressed pizza, but you need to know, you should be able to identify when looking at it that this is an all-dressed pizza. It's the same idea with your investments. With your investments, especially if you're investing in investment funds. I mean, if you're investing in investment funds, you could have up to 50, 100, even up to 500 companies within the same investment fund. I don't expect you to know every single company you're invested in, but you should have a general idea of what you're invested in, and you should be able to tell your best friend, your coworker, more or less what you're invested in. Super important. Also, to understand your investments, you also need to understand how it performs, what you're invested in, and what the risk level is. So no matter what anybody tells you, investing in individual stocks is always going to have a certain risk level to it, because let's say you pool all your money into one company. So you swear because someone told you that XYZ company is the company to invest in. So you pull all of the money that you have and you decide to invest 100% of all the money that you have into this one investment. Your performance, or how well your investment does, solely relies on how well this stock does. So if it has a bad day, you have a bad day and it drops. If it does really well, you do really well. But you're literally putting all your eggs in one basket. Can you stomach that? The average person cannot stomach that, and it's never a good idea to put all your eggs in one basket. However, I know that people do. A lot of people want to find the next Amazon or the next Facebook. I get it. But we always hear about the big wins. Like, I know somebody who invested in Bitcoin in 2008 and now they're a multimillionaire. Well, you also don't hear about the other people along the way who lost a lot of money. Okay, so you have to have a general idea of what you're investing in, what the volatility is, and you should be able to explain it to somebody else. Again, you don't necessarily need to know, when it comes to investment funds, every little ingredient, every little nook and cranny of the investment, but a general idea of what you're investing in. Again, an all-dressed pizza is an all-dressed pizza at the end of the day. I don't see any questions in the comments. If there are any questions, because I'm already on my last point, so if there are any questions, please feel free to pop them in the chat. The last question you should ask yourself before you start investing is, in very plain English, what happens if I need this money? So you're thinking of investing, you look at your finances, you're very comfortable at putting aside X number of dollars every paycheck. The goal with this money is down payment of a home or retirement, whatever the goal is. I understand the investment. I have a very good advisor, or I pick my own portfolio through self-directed investing. What happens if and when I need this money? So what does that break down to? What are the actual steps that you need to do? If you're working with an advisor, how do you actually get access to that money? If you are investing through a self-directed platform, what are the actual things that you need to do in order to get the money into your checking account so you can actually use it? What are the steps that you need to take out this money? How long does it take? So when it comes to investments, usually it's not immediate. Usually there's a delay of 1, 2, 3 days, depending on how it's invested. Another thing that I didn't mention is there's certain types of investments, mainly GICs, or guaranteed investment certificates, that have maturity dates. So sometimes you don't have the option to withdraw until the end of the term. So that's very important on when you're asking yourself, what happens if I need this money? How long does it take for you to get this money? So again, when it comes to investing, usually it's not immediate. Usually it's not a simple transfer. Usually there's a delay. So you want to know before you start investing, if I need money, what's the delay? What's the expected delay before I actually receive that money in my hands? This is crucial if you have an emergency. If you have an emergency, and let's say you're someone who doesn't have a credit card or access to a line of credit, you want to know that if an emergency comes up and I need to make a withdrawal, I have to wait 1, 2, maybe 3 business days, depending on where your investments are. What are the fees? How much is this going to cost me? How much is it going to cost me through the self-directed platform? Am I going to have any fees through my advisor? Whether it's the self-directed platform or with an advisor, ask. It's your money. So you want to set up the expectation and know that, okay, it's going to cost me whatever, $150 as an example. I know that when I do transfers out, when I transfer assets from, let's say, a bank to one of my companies, some banks charge a fee of $150. So you want to make sure that you know this ahead of time. Also keeping in mind that any of these financial institutions could change their fees at any given time. As many of you know, all of us deal with some type of bank. Fees go up, fees change, services and what's included changes, but it's for you to get a general idea. What happens if I need this money? What are the tax implications? So I posted a video on Instagram today about envelopes, about accounts or envelopes. So accounts, so TFSAs, RRSPs, locked in retirement accounts, pension plans, these are all envelopes that hold our money. And once the money is inside, it's invested the way that we want, or maybe not invested at all, doesn't matter. So once the money is inside one of these accounts or one of these envelopes, when you withdraw the money, there is some type of tax implication. So the tax implication of a TFSA, a tax-free savings account, when you withdraw the money, is that there is none. So no matter how much, as long as you are within the parameters of your limits, your contribution limits, and all the rules that you need to abide by in order to invest in a TFSA, withdrawing from a tax-free savings account is tax-free. That's what it's there for. So even if you contributed $100 today, and in 10 years, that $100 grew to $1 million. Let's say you hit the jackpot. You're not taxed when you withdraw. RRSP, different story. RGSP, RESP, you need to ask those questions. What are the tax implications of that envelope where I'm placing that money? Non-registered accounts as well. There are tax implications. You're subject to capital gains tax. So very important to know, and very important to know if you have multiple types of accounts. Very important to know if you have multiple types of, especially when it comes to retirement, multiple sources of income. You want to make sure that you're on top of the taxes. What are the taxes involved with withdrawing from an RRSP before retirement? Are there other penalties involved if not withdrawing to buy a house? So I'll start with the last question. RRSPs, if you're considered a first-time home buyer, this was a change that was made this year, but you're allowed to take out up to $60,000 from your RRSP as part of the first-time home buyers plan. So if you're considered a first-time home buyer, you're allowed to withdraw up to $60,000, and you have 15 years to pay this back. Now, it's debatable on whether it's, some people say that it sucks that you have to pay it back. How I see it is, you're loaning yourself this money, so you're paying yourself back, and it's to fund your retirement. So it's not the end of the world. And let's face it, the first home savings account, the FHSA, doesn't give you a lot of money a lot of room to increase your down payment, because even if you opened up an account last year, your maximum would be $16,000 unless you invested it well and you took advantage of the markets. So what are the taxes involved with withdrawing before RRSP? So when you make contributions to an RRSP, you receive a tax benefit, which is a tax deduction. So whatever you've contributed reduces your taxable income. When you make a withdrawal, the financial institution that you're with will keep what's called a withholding tax, and that's even before it lands in your pocket. The amount of the withholding tax, I don't know it off the top of my head, but it depends on how much you withdraw. So if you just do a quick Google search withholding tax, RRSP. Make sure you look at Quebec because it's a little bit different than the rest of Canada. It'll tell you if you withdraw up to $5,000, it's like 10%. If you withdraw up to, I don't know, $10,000 or $20,000, then it's this amount. So the amount of the withholding tax that is kept by the financial institution and reported to the CRA right off the top. And then any growth is considered taxable income. That's before retirement. Are there any other penalties involved? There shouldn't be, unless they're advisor based or not. If there are any other penalties involved, it's not a tax. It's maybe a fee from the financial institution, but there are no other taxes besides the withholding tax. And a portion of what you're pulling out could be considered taxable income if there was any growth. And then any other penalties are related to the financial institution versus the CRA. If you want the money in 7 years, is an RRSP or a non-registered account more tax advantageous? It's hard to say. It's a good question. So if you want the money in 7 years and it's before retirement, it really depends on how much you plan on withdrawing. And also in a non-registered account, it depends on the growth. So in a non-registered account, you're subject to capital gains based on your growth. So I mean, if you have money in a non-registered account and it's not really invested and there is no growth, then it doesn't really matter. So if, let's say, you place $100,000 in a non-registered account, it's not really invested in anything. And in 7 years, it grew from 100,000 to, I know I'm exaggerating a bit, but $100,000 and $500. Well, of that $500 of that growth, half of it is taxable capital gains, and that's added onto whatever you earn the year that you're making with the withdrawal. You need to pay taxes on it. So it's not a huge amount. But if you are investing, like really investing your non-registered, the money in your non-registered account, and there is a lot of growth, then the tax implication in dollar amounts, in the dollar amount, is obviously going to be higher. So it depends. A lot of it depends on how much you plan on withdrawing in the case of the RRSP and what you're investing in. So it's hard to say. But if you're looking to invest and withdrawing in 7 years, the first option usually is the tax-free savings account. If you've already maximized that, then it's one or the other, RRSP, non-registered, again, kind of depending on how you go about it. What is the age that you could take out of an RRSP without being taxed once retired? So this is a huge myth. Your RRSP, while you're working and let's say you're contributing regularly to RRSPs, your contributions and the growth is tax sheltered. But once you turn 65 and you start withdrawing from your RRSP, you're taxed. How much you're taxed depends on what your overall income is at the time you start withdrawing it. So let's pretend you're 65 years old and maybe you're still working. Maybe you're still working part-time. So at age 65, you, as an example, you are still working part-time. You're starting to collect, you have your Quebec pension plan that you're collecting. You're collecting your old age security from the federal government. And if you decide to take money out of your RRSP, 1 + 2 + 3 + 4, those are 4 sources of retirement income. The total of that becomes taxable income. Now, from your employer already sends to the CRA and Revenue Quebec your income taxes collected. Old age security and QPP do not hold the correct, they don't retain, they don't keep back the correct income tax. They don't hold the correct amount of income tax. You need to either inform them or plan yourself accordingly to either pay taxes or maybe another way. And your RRSP, it's all, just think of it as you working for part-time jobs that don't communicate with each other. Each individual job will tax you based on the income that they're paying you, but they don't know that you have other income. So once you start withdrawing from your RRSP, the money that you're taking out is taxable income. But the thing is, you're not taking out, or you shouldn't be taking out all of the money in your RSP at once. You should be taking it out over time, over 30 years or during your retirement years. For short-term investing, 1, 2, or 3 years, what's the best place to invest? Really depends on risk tolerance. And going back to, I think it was the first point that I had, depends on how married you are to whatever goals you have in 1, 2, or 3 years. In 2022 and the first half of 2023, GICs and high interest savings accounts were very popular because interest rates were high. When interest rates are high, so are GIC rates and high interest savings account rates. Now that interest rates are coming back down, they're not as appealing. But for some people, they like that guarantee. So it's kind of understanding, like, I'm not a huge fan, and I try to talk my clients out of it, but people are people and it's your money. So at the end of the day, I'm more about empowering and educating versus telling people what to do. You might go for 1 year along the lines of a GIC. I know 1 year GICs right now are about 3.5%. If you have an understanding of how investments work, you might consider some type of investment fund. So for example, if you might want to go the way of like a Canadian equity fund or a Canadian style index fund, which isn't super volatile. It's still kind of like a shortish time horizon. There isn't a black and white answer. It also depends on your overall financial situation as well. So I know that it's one of those it depends answer. How can we do index funds? Is it with the bank? Index funds, you could do it through an advisor. One of the funds that a lot of, like, if I look at all my assets under management, I have a big chunk of the assets that I manage for clients in the S&P 500 index fund, which has done really well 2023, 2024. As I tell my clients, it's not because I'm magical or anything like that. That's how markets perform. Why did markets perform really well the last 2 years? It's because interest rates went down. So when interest rates go down, that means companies that are listed on stock markets, they have more liquidity. There's more confidence in investing. So investments have done really well. So that's, there are many different types of index funds depending on the index that you want to invest in. The NASDAQ and the S&P 500 have done extremely well the last definitely this year, definitely last year. 2022, not good at all. There's also Canadian index funds like the TSX here. We have index funds here as well. Are there any other questions? Is it safe to invest most of your money in the same company or place or advisor? So I'm going to, all right, as an advisor, obviously I have a little bit of a bias, but I always try to be truthful. So when it comes to investments themselves, no matter where you go, whether it's the bank or like with CI Global Asset Management or Industrial Alliance or Manulife or any type of investment company outside of the bank, no matter where you go, pretty much most of the investments, the most common investments are available anywhere. So when somebody tells me, as an example, I have an advisor with Desjardins doesn't have good investments, that's not true. Maybe your investment might not be a good option. Maybe the advisor you're working with at Desjardins is not the best, most proactive advisor. Is it safe to have all your money in the same with the same company? If you're talking about like whether it's at the bank or like with a Manulife as an example, it's fine. I mean, these are companies that aren't going to go bankrupt or anything like that. If you're talking about investing in one company as a stock, that's a different story. Very volatile. You can have really good years and then boom, something happens. Something as unpredictable as something as a CEO, I don't know, is a racist and a misogynist, and it comes out in a video. This type of information affects share prices. But if you're talking about having everything with the same company or the same advisor, it's okay, but it also depends. Like, is this someone that you have a relationship with? If you're nervous, and I work with mainly clients who don't have any investment experience, so they're typically more nervous. I always tell them, I don't have to manage everything. Like, whatever you feel comfortable with, start with baby steps. A lot of my clients work with me as an advisor, but they also have a self-directed account. Because I encourage everybody to try it on their own. A lot of people are very curious about investing and they want to invest in Wealthsimple or using Wealthsimple as a platform. I encourage them to do so. Some of them are okay with it. Others say, you know what, I can't do it. We'll just move everything over with you. So it's entirely up to you. It's your comfort level. Some people have never dealt with an advisor outside of the bank. So the very thought of having money outside of the bank it gives you nightmares. Go at your own pace, but go. And whether you are working with an advisor or with a self-directed platform, I always say the same thing. Don't go ahead and blindly give your money either to an advisor or a platform without knowing, having a general idea of your investments. So self-directed platforms and the Wealthsimples and the Questrades of the world did heavy marketing in the late 2000s because they wanted to attract people who didn't have a lot of investment experience. They were very much anti-advisor. Don't pay so much fees to an advisor the advisor's not doing anything for you. Look, I work in my field, and I could tell you there are a lot of advisors who don't earn their keep. They do not service they don't service their clients. So you be the judge. We're women. We have a very good sixth sense. We know when something's a little bit off, but it doesn't mean to go ahead and take everything and put it blindly on a platform like Wealthsimple and trusting the algorithm, because that's not any better either. A lot of times I've worked with new clients who tried to do the do it yourself investing. They had everything with Wealthsimple, but when I take a look at their investments, they're not doing well, or they're even losing money because they blindly kind of answered the questions as you're on the platform and they trusted the algorithm to invest their money for them. That's not good either. So either or, trust your gut, make sure you can ask questions, make sure there's some type of relationship. And if you're not sure, you could do a little bit of both. How will investments be affected by the drop in the value of the loonie with Trump around? Any comments? Not going to touch too much into it, especially since this is going to be on YouTube, so I have to be careful with compliance. What I will say is that Trump coming into office, it already has had effect on markets. Don't forget that news, remember I brought up a CEO of a company, if you're invested in it and everything's going well, and all of a sudden later down the line, it comes out that the CEO is a racist, a misogynist, whatever, that could affect the share price. So any news can affect the share price of a company or a sector. So when Trump was elected, when he won the election, stock markets have gone through the roof since then. With the exception, I think there was one day when it kind of settled. This is just the market reacting to Trump coming into power. Why? Because he's very pro-business. Now, he's also announcing tariffs starting on day one. We'll see what happens, but for sure in the next few months, and maybe even a few months extended, you just have to kind of wait it out. Markets will go up, even if they dip. They will go up. Never invest money that you need tomorrow, like literally tomorrow. Invest money that could wait it out over time. So there will be some volatility, that's for sure. Everybody's talking about how great the markets are and oh my God, Trump is coming into power. That's not going to last, especially we're at the end of the year. Companies are going to do their year ends and cash out and this and that. They're going to rearrange their finances to do their year ends, just like business owners on a much smaller level. It's no different in publicly traded companies. And that's it. So we'll see what happens. I would like to invest in ETFs. How do you find out what the MER fees are for each? It's public knowledge. So if you're looking at a specific exchange traded fund, it's public information. It's posted, like you could Google exchange traded fund, whatever the ETF is, and companies are required to declare it by law. Are there any other questions? Exchange traded funds, by the way, were created to compete with mutual funds. Basically, you could invest in ETFs through do-it-yourself platforms like the Wealthsimples and the Questrades. You could also invest in ETFs through an advisor. The idea of ETFs was for investors to do it on their own, just like you would buy and sell shares in a company, in a publicly traded company. ETFs you could buy and sell on a self-directed platform, just like shares of a company. ETFs, yes, you could do it with through a bank as well. Are there any other questions? What's a good average MER rate? It depends. I don't work with MER rates that are super low because I'm an advisor and I have to get paid somehow. I know that, so how I get paid on a commission is not the full MER rate. So if you're looking at an investment fund, if you're looking at the fund fact sheet of wherever the fund is, and you look at the average annual return, it's 8%. And the MER happens to be 2%. So that means that fund on average earns a gross return of 10%, but they keep 2% to pay for expenses, including my commission, advisor's commission. At the end of the day, MERs don't really bother me, even as a general public. What I'm more worried about is the service that I get from the advisor. So there are some funds that are more technical, that are more actively managed, where the MER is higher, but the returns are higher in the long run. For me, it's all about, okay, what's the average annual return? What am I looking at as a return? Because if you see certain funds where the average return is in the 20s, then you don't really care about the MER because you're making money. So there's not really an answer to that. There are other funds where the MERs are below 1%. ETFs tend to have very low MERs, but then there are ETFs who have higher MERs because they're more actively managed. Any other questions? Okay, I had a bonus answer, which I already answered anyway. Or do I work with an advisor or use a self-directed platform? I already kind of gave that answer. Whatever you do, whoever you choose to work with, whether it's an advisor or a platform, always be controlled and be empowered of how your money is being invested, and having the education to know where your money is going, what happens when you need to withdraw, and kind of have a general idea of how you're going to be taxed at withdrawal, no matter how you invest your money. I know that for myself, I spend a lot of time on education and empowerment. I never put my clients in a situation where it's like, okay, this is what you're going to invest in, sign here. I want to make sure that whatever we discussed as investment options, tomorrow when you wake up, you're still going to remember what we talked about, because I try to explain everything in simple jargon. Self-directed platforms are great if you have a good base in investments, so you understand. For example, my husband, he only invests in self-directed platforms, but he is an investment buff. We both get up and watch the markets and look at the markets overseas, and we know what's going on in the economy. If you're just trying it out and you're a beginner, you could get away with it, but at some point you should have the education on knowing what you're invested in. And again, once your portfolio gets a little bit more complicated, it's just the same idea. If should you do your own taxes or get an accountant? You could do your taxes yourself through TurboTax. If everything's simple, straightforward, if you're someone who just has a salary job with a T4, it's super easy to do. My kids all use TurboTax to file their income taxes. But once your situation starts getting a little bit more complicated, or you want to be able to know how to manipulate your way through, sometimes it's better to work with somebody, and not just anybody. Not every advisor is the same. Not every accountant is the same. Trust your judgment. Again, I said it before, we're women. We we know when something's right, when something feels right. We know when something feels off. Where can we watch the markets and know what's going on in the economy? I know I get up in the morning and we watch BBC, we watch CNBC, MSNBC, BNN Bloomberg. We flip back and forth between those channels. That's what's on TV all the time for me. So those are the market channels that I watch, and you could pretty much get a glimpse of everything. When I get up in the morning at 5, I'm an early riser. When I get up in the morning at 5, overseas markets are usually dying down, so we get the news from there, and then we're getting into the futures, like how the market is, the trend of the markets that are going to open here in North America. I'll take one or two last questions if anybody has. In the meantime, for those who have a business, like I said, we host the Breakfast Club for Women Entrepreneurs every Friday at 10 a.m. This Friday, the topic is going to be year-end tax tips for sole proprietors. So if you are self-employed, non-incorporated, please join us. I'm going to put the link in the chat for this Saturday. I posted it twice. For this Friday. And for next week, I think I'm all investments out. I've been spending the last 4 weeks talking about investments. Next week, the topic is going to be choosing the right life insurance. We're going to go over the different types of life insurance and how to determine the right type of life insurance for you, and if you even need life insurance. So this is for anyone who's thinking of getting life insurance, or maybe you have existing life insurance, either personally or maybe one of your parents took a life insurance policy out a while ago. You might be asking yourself, should I still have this policy? Should I replace it? Should I cancel it? I'm going to be covering all of those next week. So I don't see any other questions. So if there's anything else, my email address is there. Feel free to reach out if you have any questions or comments, or if there's something that wasn't clear, maybe you were too shy to ask in the chat. For those of you who are watching the recording later on, the same thing. And hopefully I'll see you either Friday. We have the annual holiday party, which is Saturday. We're sold out, but we do have a waiting list. So if you'd like to attend, shoot me an email. It's a sit-down dinner at a Lebanese restaurant it's central in Montreal. So please feel free to reach out. That's this Saturday. And next Tuesday on our Tuesday webinars, we're going to be talking about life insurance, everything about life insurance. So I appreciate everyone coming out this evening. If you have any questions, feel free to reach out. Other than that, have an awesome week, everybody.